Now, as we move through the spring of 2025, I want to take a moment to share my thoughts on the current state of the housing market here in Santa Clara County. I know there's a lot of uncertainty right now. Headlines about tariffs, interest rates, inflations, and global instability are dominating the news. And I know many of you are wondering how all of this is going to affect your real estate decisions. So I thought I'm going to share with you my thoughts. Now, this environment reminds me a lot about what we experienced in April 2022. At that time, mortgage rates had just jumped and the housing market paused. Buyers pulled back, not sure what to expect next, and then therefore the prices began to fall. And over the following 6 to 8 months after that, the home values did decline about 28% from their peak. That was a significant correction. But what mattered more was what happened next. By early 2023, the market has stabilized, and then April 2024, prices had not only recovered, but actually surpassed the April 2022 peak prices by more than 2.5%. And even at the time, mortgage rate was nearly twice as high as they were 2 years prior. Well, that kind of recovery is not typical. It happens in places like Santa Clara County because of who lives and works here. This region is supported by one of the most resilient, highly skilled, and forward-thinking populations in the world. And people here, they understand long-term value. They adapt really quickly to changes, and when the market shifts, they typically respond with strategy rather than panic. And today, we are seeing another market pause again. Beginning the week of April 7, we saw that activity had slowed down quite significantly. And many sellers listed properties as expected during this spring cycle, but even though we have the demand, buyers suddenly they just kind of stepped back and didn't want to make an offer. In some cases, we did see prices actually drop as much as 5% within just one single week. Now, the cause, again, I don't think it's fundamentals, but it's more sentiment at this time. The emotional weight on the ongoing tariff announcement, inconsistent national messaging really has led to a lot of hesitation in the market. Just like in 2022, I believe that this pause is temporary. But what I think is often missing from this national conversation and the broader economic context is that, while it is true, the United States continued to run this trade deficits in goods by $1.213 trillion as of 2024, we also posted a $295 billion surplus in services. And that surplus may seem minor compared to the overall deficit, but it is a powerful indicator of where our economy is the strongest. That strength is actually right here in the industries that define Silicon Valley. The software, cloud infrastructure, telecommunications, financial services, and intellectual property continue to be among the most globally demanded and profitable sectors in the world. And these industries are not just growing, they are far less exposed to this kind of tariff-related risk that are affecting traditional goods-based sectors. Now, yes, there's going to be some kind of effect, but Santa Clara doesn't export hardware only. We export innovation, ideas, and infrastructure, and we're doing it profitably. Of course, in the broader economic conditions remain a factor. Inflation continues to be a concern, consumer spending slowing down, Federal Reserve then have to face this very difficult decision. If we move into a stagflation environment where the inflation remains high and the economic growth slows, the Fed probably not going to have that much flexibility to lower rate as quickly as the market would like to see. But on the other hand, if the inflation starts to ease and economic growth softens, then rate cuts may happen sooner than expected. So I just want to be clear. I'm just observing the environment and how it might influence the economic policy. This is my thought. It is very reasonable, I think, to expect that the current president will seek to improve the economic narrative for his presidency. If the economic indicators start to decline very sharply, I believe we could see some kind of stimulus efforts, including certain speeches or more aggressive action to aim at improving the sentiment and conditions of the market. Now, when rates begin to come down, even modestly, especially in our market, we typically see buyers move rather quickly. A lot of buyers have been waiting, and not because they don't have the means to purchase, just because they are waiting for the confidence to return. That is the psychology of this market, and it is shaped by data, yes, of course, but also by experience and confidence and emotion. Buyers here have seen this cycle before, and when the moment feels right, they will act. So, looking ahead to the next 6 to 12 months, I see three general scenarios. I see that in the most pessimistic case, where recession fears grow and political and trade uncertainty continue, we're probably going to see price soften by another 10 to 12% in the next 6 to 9 months. But in a more neutral environment where the economy maybe finds some kind of footing and the rates start to drop, the market could flatten and begin to have a steady recovery by probably early 2026. In the most optimistic scenario, where the tariff concern is eased and the mortgage rates are to lower as well, and we're gonna see the buyer sentiment to come back, and we're gonna see the activity to start again, where the market is gonna jump back up 5 to 10%. So I hope this information is helpful for you to make a decision where you are in the real estate market. And if you have any questions at all, feel free to reach out one of the agents, and we will be more than happy to share more of the update on the current market, where we're on the ground seeing the buyer activities every single day. Thank you so much. I'll talk to you soon.